Good morning, everybody. Kia ora koutou. He honore, he kuroria, manaronga, he te whanua. Te kario pai e ki ngā tangata katoa. Aki, amine, te atua tiparinga, toka uranga. Honour, glory, and peace to the land. And may good thoughts come to all men forever and ever. The Lord is my refuge and my life. Welcome to this meeting. It's the final meeting of this podium as a finance meeting, so it's I guess it's will be memorable. We have some apologies today. Kevin Malcolm, Michael Laws, and the ones I'm aware of at the moment. Any others? We've got Gary online. Good morning, Gary. And we don't have a public forum. In fact, we've only ever had one. Confirmation of the agenda. Now there has been an error in the agenda that was sent out that was intelligent. The attachment of the comprehensive revenue expenditure was actually not there, and we have actually recirculated that, but we've got hard copies, 2 hard copies here of the agenda with the correct documents. If anyone would like that, we can hand that out to you. Okay, otherwise we'll just, okay. Declaration of interest, just a reminder, if they're to advise, please do so. We don't have any presentations at all. So we'll just move on to the confirmation of the minutes. That was the meeting that was held on the 22nd of May. So everybody seen those minutes? Are there any errors, errors or anything that needs correcting in there? Okay, thank you, Kate. Second, Alan, in favour?
Aye.
Against? Thank you. There's an action that was in those minutes, and we've got that today, so that's it's good to see. So let us move on to the quarterly financial report for the 30th of June 2025. It's the year end, so it covers the 12 months. And, Nick, welcome.
I've got Sean is online as well. Sarah's not here because she's in the thick of year end with the auditors. She does the balance sheet side of it, but most of the reports there are put together by Sean and his team. So this is the year end result. It's not in the full financial statement format that you see in the annual report. That goes to audit and risk in a few weeks' time, and then on to council next month. But this gives the preliminary result. Hasn't been audited, so the auditors are in now. They're about halfway through. They're a week and a half into 3 weeks. Usually when we come to the finance committee at this time, we'd have the year-end result. We usually don't have the port revaluation in there. It is in this time because this meeting's actually a couple of weeks later than what we usually do. Finance is usually towards the beginning of the month. And at that point, we usually have all the operating revenue and expenditure and everything sorted. So we have the operating surplus and deficit to report, but we usually don't have the port reval. But because this meeting is a couple of weeks later, we have had the valuation done. So that is in there. So that gives the headline, or you like, if the bottom line figure, which is the comprehensive revenue and expense number, that is 65.7 million, which is just over 38 million ahead of budget. But that has the port revaluation in there. The port revaluation for this year is 55.4 million. and that was budgeted at 28.1. So the bulk of that in that line there, which is the very bottom line, is down to the port reval. The key thing then, the rest of the report and paper focuses on the next level up, which is the operating surplus. And paragraph 3 there points out that in an operating, from an operating point of view, our operating surplus was 10.356 million, which is 10.775 million ahead of budgeted, a budgeted deficit of 418,000. The key thing to note there is that includes the 4.5 million gain on Birch Kitchener. There is a further additional gain on the managed fund of 450. So those two unrealised gains are 5 million of that 10.7 million extra. The exec summary then goes on to outline some of the key points that make that up. But if you take out the 5 million extra, it leaves 5.7 million remaining. Of that, there's 3 big ticket items. The paper goes through and lists, gives commentary on a whole lot of the variances, but 3 big ticket items that make up that 5.7 million. There was additional operating revenue and grants in relation to the Contour Channel. That was it wasn't known at the time that we set the budget. So that came in, but it's capital expenditure, so you get an operating gain. But we got the grant funding, $2 million. There was policy and planning work. We'd always indicated in Q3 that the land and water plan was going to be underspent. We forecast 700,000. Land and water plan came in 1 million, and the other policy and planning work came in $700,000 under. So policy and planning work was underspent by 1.7 million, and river management across all of the schemes was 1.25 million underspent. So those 3 items actually make up $5 million of that additional surplus. So that's the key highlights. That's what's covered in the exec summary, and really just happy to take questions. And Tim, usually you like to go through the individual pages. There's this, as Tim pointed out, there's the scree has now been distributed, and it has the activity reports with it. And then there's in Diligent, there was the balance sheet, the treasury report, and we've added a reserves report to show what those reserve balances are. And that's where we've split the historic transport balances out into a separate reserve on that. So as we can report on that as we go forward to Finance Committee and show clearly what's happening with those deficits as they're repaid and what the underlying, if you like, new transport position is.
Yeah. It would be good if we could go through those activity reports, Nick, and then sort of refer back to the carry forward balances for each of those. I know you've got them in the table, but if we could go through the activity, not in any kind of depth, but just we don't do it regularly, and because this is year end. Let's have a look at that, and let's have a look at the balances being carried forward on those activity reports. But happy to take questions on the result at the moment. Kate.
All right, thank you. Apologies, I'm going to be pedantry, but paragraph 2, which sets the scene, and I just want to check the revaluation gain, which of 55 million, is an incorrect statement. It's a revaluation gain of 27 million, which is still substantial in Port Otago, because you've got it's 55 million, 400,000 revaluation gain. That's not correct, is it?
Yeah, no, that's the movement in the share value for the year. So that's the total gain, but we budgeted 28 million. So we've got an additional 27 million over and above what we budgeted.
So what is the total value? These numbers are relatively big, and that sounds it.
Total value what is on. So if you go to the balance sheet, so statement of financial position, which is page 21 on Diligent, there shares, and so first item in non-current assets, shares in subsidiary.
Sorry, this is a problem. It's really hard to read this when you're juggling between the pages. So here's the subsidiaries.
Yep.
And that's 1,700. Okay, so it is
788 million. Yep.
So that's the port valuation.
Yeah, that's the share value of the port. Yep.
okay. Sorry, apologies for that.
That includes the additional 55 million.
Yep. You can
This
see there the next column over. Last year it was 732 million, and it's
Yeah.
got the variance as the 55 gain.
Apologies for that. I had taken that was a revaluation. It seems somewhat astounding. Revaluation, but that's
Not that much.
going to be a conversation that's not for here. It'll be an annual report.
We can have that conversation.
Yeah.
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 There's nothing to discuss, it's just valued.
Yeah, but this is one that where the auditors always pick us up on as well. The valuation of the shares.
Yeah, the auditors will always look at this. This is what we've had the valuation done. We get it revalued every year.
Yeah.
And that's what our revaluation has come in. The auditors will look at that and they'll go through and do their own review of that. Whether or not whether they'll have a different view, but sometimes they sort of, they might, their calculation might be slightly different, but
Yeah.
so long as
We
it's
talk-
within the margin of error, they've never required us to restate that number.
Yeah. Nick, we spoke about this on Monday when we were looking at the agenda, and there were two aspects to the port revaluation that you want to. There was more of a revaluation at the port this time round than on their property portfolio.
Well, it can vary every year. So obviously the port has two parts to its business. Got port operations and then it's got the property company. So the two valuations, although it's done as one valuation, the two parts of the business are valued differently.
Yeah.
The port operations is done on a forecast profit, and then that is discounted back to a net present value. Whereas the property company is just done on a net asset value. So it includes any, what their underlying property revaluations are. Both sides of both parts of the business both increased. If you look at that 55 million, it's a 7.5% increase. Both increased approximately the 7.5 million, 7.5%. But of that 788 and previously the 732, the split is basically 2/3 of the value sits with the property company and 1/3 with the port. So they both sides increased 7.5%, but more 2/3 of that 55 million was attributable to the Chalmers property.
Look, that's fine. I'm sorry. I had misread that completely because the big numbers, and I had made more sense not to be the case in my head when I read that. So apologies. Then the question I have on that then, was that realised on, there was an internal sale for Birch Kitchener, so that doesn't necessarily reflect the market. No, I was thinking that did that valuation go up 7.5% as an example, but that was an internal sale, so it won't necessarily.
Well, the Birch Kitchener it doesn't factor into their year-end value because they'd sold it to us during the year.
Yeah, no, I was meaning the value, but that doesn't matter because it's different sale anyway. It was, it was foreshadowed earlier.
And Birch Kitchener, we sold back to them.
Yeah.
So I don't know what the value, what values are attributable to individual properties. So
I think the only surprise in this result is the revaluation of the port coming in a lot higher than we thought. We had in all our forecasts leading up to this year. We knew that Birch Kitchener had an influence on the result, and we also knew that there was gains that had been made because we hadn't continued on with the land and water plan. So that there's no real surprises today apart from the port.
Yeah, the port is on, and it does. Sorry, I almost convinced myself that the other way around. So thank you.
Oh,
thanks. Yeah, look, I just had a question about those historic transport reserves you referred to, Nick, which are on that report 913, page 22. Both the Dunedin and Queenstown historic reserves. I was inquiring why there are transfers out of those reserves. And I just wanted to check too, with the Dunedin one, we had agreed that those would be repaid over 5 years. That rate doesn't look as though we'll have paid off the Dunedin one. I wanted to check that was the case. Yeah, both of those points are good points to raise. Transfers out is interest. So all of our reserves, apart from, some of the ones that are sort of just that are non-cash reserves, like if you like, the asset revaluation and port revaluation, the ones above, they don't get interest attributed to them, either earn it or pay it. But the other ones, they will pay or earn interest depending on whether they're in debit or credit. So yeah, that's what that is. Obviously, it's bigger in Dunedin. It will come down as the balance drops down over the years. And yes, the Queenstown is probably on track to be paid off in the 5 years or approximately. Dunedin is probably looking more like 6 years because the balance that we started with was actually higher than what we forecast when we were setting the annual the LTP. So it probably, I thought it was slightly less than 6, but now with interest, yeah, it'll probably be about 6 years. Okay. But the way I've sort of looked at that is, for now, we're just doing it the same as what we had. And when we look at the next LTP, council can look at whether they want to adjust that rate to do it over 5 or leave it just stretched out over a slightly longer period. Okay, thank you.
Question on that, Alexa.
I won't be able to find this now for sure, but I've got a note about what's that? The infrastructure spend. So we've underspent on a lot of that infrastructure, and I'm wondering why that's underspent. Is that reasoning in here at all?
So you're talking infrastructure, you're talking operating underspend or capital underspend?
The capital underspend was actually what I noted. But,
yeah, so the capital is the CapEx report is in that additional report that was sent out, the PDF with the SCREE activity reports, and then it's got the CapEx report.
That's why I can't find it now.
Yeah, so it's in the PDF one, and it's the last page of that. It was 8 pages, and it's page 8.
Okay.
So yeah, I mean, the thing is, if you had any specific questions around any of the lines in there, it's a matter of...
There's a mixture of things in there, Alexa. The timing of Whareunaka has impacted capital budget. So in terms of where we had budgeted to be spending on fixtures and furniture and fittings and things is pushed out as we're now moving in a little bit later. There is some underspend due to timing in the flood and drainage works, but it's sort of a range of things listed there rather than there's some IT projects again where the expenditure that we're incurring is not as it was expected when we set the long-term plan. So I don't think it's all attributed to sort of one area where we would be significantly concerned that we were falling behind, as opposed to spread over all of it, which is just really something for us to consider when we set the budgets in terms of confidence of when that spend will be incurred.
So it's all kind of in train, just shifting around. Yeah. That's good, thank you.
Paragraph 18 did outline what the variances were, what the key variances were. So whether there's anything specific in there that sort of answers.
No, it's not specific. I was just thinking, is this, how come it hasn't been done?
Lloyd, did you have a question?
Well, yeah, I just had a really quick question back on those reserves for the public transport. Do you read the closing? Back on the reserves for the public transport, the closing balance, do you read the closing balance with the 2 lines added together, or is it just the second line? So you've got the transfer in and out with the interest taken off on the top line. Then the second line has got the Dunedin transport historic balance, and then the transfers in and out to the 1044. Which one? Do you have the 1044 and the 360 together?
No, because effectively they're separate reserves now. So
Oh,
the
okay.
historic balance, start like if you
Oh, that's
take
because
Dunedin.
we had the two and then.
Yeah, started, so just the way to look at that, historic balance started at 0 and the other one,
Yeah.
the rest of our operating for this year,
Is in the
it
second.
started that was 0, but the historic balance started at 12 million. We rated 1.8 million, then there was the interest that got charged on that.
Oh,
So
okay.
it's got 10.4 million remaining. And the Dunedin, which if you like is the operating balance for this year, what goes in and out, all of the expenditure goes in, or all the revenue goes in, and then all the expenditure goes out. And we're left with 360,000 that we effectively were over, which that relates back to the activity for that, for Dunedin Transport.
Oh, thanks for that clarification.
Kate?
Look, just for clarity, you mentioned at the start that the 1.25 million underspend for river management, and I'm just checking my mind. So if I look at paragraph 18, which talked about the bridge, is that part of that underspend?
No,
That's
because
not-
the bridge is CapEx, so the
CapEx, so the other-
1.2 million is just the operating
Okay.
underspend. Yep.
And so the question then, and that's good to clarify that because I wasn't sure, the question I've got then is, what does that look like for this year's funding and work program in that area? Because I know it's one that's keenly, and what are the areas that is it one or two river systems, river management areas that were underspent, or is it right across the board?
There is some underspend across the board, but there are some areas where we got much closer to our area specific budget. One of the main areas that we underspent in was the Upper Lakes Wakatipu area, and we're revising that work program at the moment with a view to reassessing our budgets through annual plan. The majority of our other budgets that were underspent were more marginally underspent. That we are looking really good to catch up on that and potentially eat into some of the underspent from last year, this year.
Fabulous. It's one area that I probably get more comments about than any other. Thank you.
Yes, Andrew.
Thanks, Mr. Chair. In paragraph 6, it talks about the additional depreciation of about $500,000. I just wondered whether that related to, or what that related to, plant purchase infrastructure or additional infrastructure.
What paragraph?
Paragraph 6.
Paragraph 6. No, did I not flip? Appreciation. I had did I have it? Some of it I know was in the IT space. I think that's mentioned.
That was for the website.
Yeah. Yeah. So from memory, it was sort of just across the board. Yeah, there's in the table in paragraph 15, the operating surplus variance, we mention we do mention the 145,000 in IT. And that was, did you say that was the website? And there was actually some other amortization of software that was just over and above, also in IT, which I hadn't listed there. And then I think the difference is about 500,000. So IT sort of had about 300,000 of it, and the rest of it was just sort of small amounts. Effectively, it was, we just under budgeted the depreciation budget, because depreciation, when we set it, we start by, based on what we've already got. But there's always a timing difference of how early we're starting the process and whether we capture things that come online during the year before. So it was really just, there was nothing sort of significant more than 100,000. It was just sort of little bits across all parts of the business that made up sort of the other couple of 100,000.
Thank you.
I think I've just got a question in regards to page 22, which is the summary of reserves. In the general reserves, we've got a total value of 880,000. Of course, the port revaluation makes up a big portion of that, 768 million. But we've got a general rates reserve there that's got a carry forward closing balance of 69,226,000. What's that being carried forward for?
Well, it's really just, while it's called the general reserve, it's really just it's really just the residual of our equity that doesn't belong to the other reserves. And in the past, I've done some analysis and brought papers, well, usually done it when we've been doing LTPs or annual plans, because that's just there as the general reserve that council it can use as it sees fit, or it's used to fund things that weren't budgeted through the year, or in this case, it's gone up this year because a part of that additional surplus goes into the general reserve. But it does need a little bit more analysis, because not like some of those other reserves, not all of that relates to cash. Some of the other reserves are pure cash reserves, like the Kiraueo Fund is effectively that reserve has that all as cash. So in the past, I've done a reserves analysis where I take all of those reserves and I take out the ones that have their cash, and you've got to tie it back to what our actual cash position is, because we've got managed fund, which is effectively cash, and then we've got our cash and cash on hand. And when you do that, there's actually a much smaller portion of that general reserve is cash, because some of it can be like with these other reserves. Some of it has just been created over time. Some of it relates back to when council was first created, and effectively all the assets that were vested to council. On the other side of it, you had to create an equity entry.
So it's more of a general reserve than a general rates reserve. Is that what you're saying?
Yeah, it should actually. Yeah, it should. We should call it the general reserve, not general rates reserve.
What I see there is general rates reserve.
Yeah,
and that talks to me about surpluses from general rates being carried forward.
Yeah,
and accumulated over time. We've got a balance of $69 million there.
Yeah, and all of the others, I don't have rates in there.
Yeah. Perhaps we should change the name of that reserve.
Yeah,
it's misleading.
Yeah, that's easy to do. It's not all been, because that does sort of imply that it's all been created from general rates, and it hasn't. There's been vested assets, as I said, when council was created, and other non-cash items have gone in there. And in the new triennium, I'll bring that back to council and say, here's what our actual cash general reserve is, because that's what council effectively has got to play with.
Yeah. Just another question, if you don't mind, and it's just we've got a balance sheet that shows a total reserves of $811 million. So that's in the equity section. So we've got public equity, and then we've got reserves 811316, and we've got this summary of reserves report here that gives us a total of 925 million. Should there be some sort of reconciliation between these two amounts that makes sense?
So if you look on page 21, the net assets and total equity is 925,440, and then on page 22, the closing balance of all the reserves is 925,440. So those two
public
numbers.
Equity is what was that initially?
Yeah. So total equity.
No, the public equity portion of that 925. What is that then?
That will be. I'd have to go and reconcile which ones go where. But it'll be the general reserve and some of the other ones I'd have to go away and, obviously they reconcile at the total level.
Yes.
I'll just have to go and look, it'll just be, I'd be able to go away
Okay, no,
and
just,
work out which one's going to which, but
Yeah.
haven't done that reconciliation.
okay. Any further questions on the SOCRE? You want to just take us through the activity reports?
So the activity reports, if you start with this is the PDF that got emailed out, came out separately. So first page of that is the statement of comprehensive revenue and expenditure. As I said, you've got the 65.7 million total comprehensive revenue and expense. That's 38 million ahead of budget. The operating surplus, a couple of lines up, is that 10.3 million, so that's 10.7. So we'll sort of talk through that. That first page also then down below does an underlying reconciliation for the operating surplus. So it then takes out the Birch Kitchener gain on sale of 4.5 million, and that leaves an underlying comprehensive revenue and expense variance to budget that is just over $6 million better. We've sort of, that's the standard report or the scree that we've sort of showed in that format for all of these meetings of the finance committee. Next page just breaks the operating down. Now, what that shows there, total council, the variance on that second page shows as 5.6 because this is only revenue and expenditure. It's not, doesn't include the other gains and losses. So it's one line above again, but it just shows by group activity where the bulk of that operating surplus has been generated. So you've got the 5 group activities and then the significant activities that sit below that level. And then this is really just a one-page summary of then what you see in detail. Obviously, there's a full page for regional leadership and a full page for environment, etc. But this is the one-page summary that hopefully just at a glance allows you to see where that that operating surplus, where the extra was coming from. And you can see there in the environment space, water, which has got land and water regional planning, there was an additional 1.9 million there. Page 3 is page 3. Page 3. So page 3 is then on to regional leadership. So now from these pages from here on, you just get the full, the breakdown showing what the items in revenue and expenditure are for each of the group activities, and then it has the significant activities down below, just showing their total revenue and expenditure. So regional leadership, you can see there, so that generated a surplus across those activities of just over $1 million, and the budget was basically to be a balanced budget of, so effectively zero, so 1.1 million better for regional leadership. Environment on page 4, so that generated a surplus of almost 2.2 million. Again, budget was meant to be zero, so the environment space was adding 2.2 million. If you go down, you can see, as I sort of mentioned, land and water planning down towards the bottom of the page. That was underspent by just over $1 million. So that's one of the contributors there. And then there was some in the, some of the other areas in that water space that also contributed, a further 900,000. Third page is safety and resilience. So this is where all the flood and drainage and river management are. So you could actually see there, we were budgeting for the full year for a deficit in this space from an operating point of view. So that was because we phased the rates in for flood and drainage and river management. There was a big jump in both operating and capital expenditure. And what we did is we looked at what we needed over the 10 years in those activities. And then even rather than just having a straight line increase, same percentage every year, we phased the increase in over the first 3 years, which is one of the reasons why then when we have now not had as much expenditure, we've now got the surplus across the whole safety and resilience is now sitting at 295,000 because it was meant to be a deficit. That's then meant that when you have a look at the reserves, say in the river management area, it's not like those reserves have jumped up significantly, even though they were underspent, because we never actually fully rated for what we were expecting to spend, particularly in year one, but even in year 2 and 3. So that's actually, from a rating point of view, the fact that we did it that way has meant that our rates take this year was actually more in line with what we actually spent. It's just our budget had us expecting to spend a lot more.
The other big shift in that safety resilience, the $2 million we got for the contour channel wasn't budgeted. So when we have updated the annual plan for the year we're in now, obviously we've reflected that government funding for that project.
Yeah. There's a lot on safety and resilience page. Transport then is transport overall surplus is 1.48, so almost 1.5 million. We're expecting budgeted for 1.6 million. So overall, it actually transport came out very close to budget, but there was an under and an over with Dunedin was effectively 400,000 overspent, and Queenstown was 500,000 underspent. So that Queenstown one we carried forward to next year, and the year end came out pretty much in line with our forecasts.
So Nick, just for clarity, we've obviously talked about running balanced budgets for transport, so we don't end up getting ourselves into that same position, but balanced budget effectively will always read as a significant surplus because we need to rate to pay back those deficits, those historic deficits. So it's starting with 0 plus whatever we are rating to pay those historic deficits, and that is the surplus we should be budgeting for year on year within transport.
Oh, sorry, Kat.
After the decisions yesterday on total mobility, can you just understand how that then relates to those for this quarter and next quarter, what the effect will be ongoing? So that will reduce the surplus.
This is last year's.
Yeah, no, I appreciate that, but so just for our,
So overall,
Yeah.
I think we almost need to, and I've talked a couple of times about how we can present those historic transport deficits in a way that almost separates them out from the balance of the budget. But effectively, we will start to eat into that surplus because of the pressure on the total mobility budget. We will still make the historic deficit payment because it's rated from a particular group, and that money will always go into that into paying back those deficits. But then the balance of the transport budget,
this is generally rated.
general rates, we will start to see a significant deficit in that area.
Yeah, I just think it's, and the reason I want to pull that out is understanding that we had some hard choices to make between children's fares and why we went to lobby the government on that, because we understood that we were going to be 2 negatives happening, and we had made difficult choice between total mobility and or that. And I just wanted to be really clear about that because we know that we understood that this was an ongoing problem.
Yeah, the two, the as Richard said, the two separate things. You've got
Yeah,
you got PT in Dunedin and Queenstown. You know, we're trying to balance those. So you've got to take the historic deficit out of the picture, but we're trying to balance the ongoing. The total mobility sits in public transport other.
Right. Yeah.
So this is year end. We will, based on, you know, where the paper yesterday and when we do the Q1 result and we'll do the forecast then, we'll obviously update. The forecast will reflect where we think that it will land for the year that we're now in. So that'll be the first time when that comes to council, you know, after the elections.
Yeah.
It'll hopefully be either late November or early December, but we'll have a forecast position on how this current year should look then.
and so that being an operating deficit, running that is how, and that will be a catch up on general rates. And would be down the following year, potentially.
Yeah.
But yeah, ups and downs throughout the whole budget.
Yeah.
It'll start having an impact later in year 2 and then into year 3.
Yeah,
Yeah, there was back in the actual paper, I put a table that shows just at a group, you know, significant activity group and then significant activity level, where the variance to surplus for each activity flows through to, whether it's general rates or a targeted rate. So this year, total mobility, I think was about 240,000, you know, deficit, which was effectively the share that we didn't rate for because we'd already set our budgets and rated for it. So there was a deficit there. So that's just part of that overall variance in general rate funded activity for this year, but offsetting it, there's all these other activities that were underspent. So in fact, you know, we had sort of the best part of $3 million of additional surplus in general rate activity, even after, you know, an extra 200,000 have been spent in total mobility. So what we'll do is with the forecast going forward is we'll do the same and say, right, well, based on how it should be funded this year, you know, there'll be X amount that probably we will be short, and effectively that comes out of the general reserve.
thank you. I just want to be really clear about that going forward. Thank you.
Okay, I think we've got corporate too.
Yeah, so we were on, so corporate, again, overall corporate, it was budgeted that we were going to have just under $1 million deficit. The actual deficit came out at 1.3. So it was actually fairly close in all of those areas. The key thing to note would be there is more that goes on in the next page, which is capital expenditure. Some of these corporate areas have, you know, information systems, property, and Whare Runaka. You know, they have other expenditure in capital. So this is only the operating expenditure. But from an operating expenditure point of view, overall, the internal or corporate areas were all fairly close to budget.
Well, the variance is pretty much depreciation, isn't it, really?
Yep. And then the last page is the capital expenditure page, which I referred to earlier in the meeting, and which was a summary of those key variances, actual versus budget, was in paragraph 18 in the paper itself.
Mm-hmm. Okay, that's pretty thorough. Are there any further questions? That's good. Shall we have a look then at our non-financial activity performance?
That's a separate paper.
Yeah. Oh, sorry. Okay, we can go back to okay, yeah. All right, so quarterly finance report, the recommendation is that the finance committee notes this report and the attached financial reports for June 2025. Moved by Elliot, thank you. And Alan, thank you very much. All those in favour, please say aye.
Aye.
You. Okay, let's have a look at these non-financial activities. Welcome to the top of the table, and we're in your hands. And it is Vanessa, is it?
Yes.
Okay. And,
Kia ora koutou. So this report is for Q4, representing the full end of year non-financial performance against the measures and targets for year one of the LTP 24-34. As Nick mentioned, the non-financial performance results are also still in the process of being audited for the annual report. To provide an overview of the 59 LTP service measures, 44 achieved their targeted performance, which is 75%, and 15 were not achieved or fell short of the targeted performance. There were no service targets considered to be partially achieved. So partial performance has been used where a predefined level of measurable progress can be demonstrated or work has been delivered, but the reporting time frame did not meet the LTP stated target date. So paragraph 9 of the report highlights the year's key achievements, so specifically where service performance measures surpassed their set targets. And starting from paragraph 11, this provides more detail on the 15 or the 25% of the service measures that were not achieved. Each of these results was reviewed individually to understand the severity of the gap. So of the 15 not achieved, 4 were within the 5% of the desired result. This narrow margin was not considered a substantive service miss, and the performance was close to expectations. Additionally, 3 of the 15 measures were impacted by changes in context or timeframes set by central government. So a further 20% were considered as currently out of our control. And that's really pretty much the overview. Happy to take questions.
just in terms of, last year we had auditors changing some of the achieves or not achieves. Is it likely we're going to see that again, or have you sort of preempted that by being conservative in what you're presenting today?
Yeah, I think we take the latter part of it. So we preempted that, and that's why kind of none of them were in the amber space.
Yeah.
Yes.
So yes, we can throw this open for questions. And once again, Richard, it's good we're getting this information through every month. So there shouldn't be any surprises in what we're seeing here today, which could result in lack of questions. But generally, I think that what we're seeing is what we've seen before. But yeah, just open it up to the council for any questions if they have any. Yeah.
Yes, thank you. Look, just checking the notes about the air plan presumably were written before the recent government putting a stop on plan changes. The notes on the air plan on pages 26 and 33 still say delay in notifying the plan to at least early 2026. That date needs to be revised, presumably in the light of recent developments.
Yeah.
Yeah, thank you. And just note that's most unfortunate that we are having to delay that further.
So I'll just echo, I mentioned that, yesterday that we've got some measures within this year's, which we will start to report on from next month, that will immediately be ready for those reasons. Yeah.
So we need to have a way of showing that it's not red because of our actions.
Yes.
Or inactions. Yeah.
Elliot, did you have a question? Yeah.
I was just gonna ask around the reliability and punctuality targets for the transport. So obviously 99.7% reliability for Dunedin is great, and then the punctuality figure slightly less great with 85.7. I'll wait until Transport Committee next week to sort of ask around how we're improving that, but I'm just keen to ask around the targets themselves. So recall we adjusted some of them a while back, so there might be a specific reason for this, but I'm just wondering why we have the same target for reliability and punctuality. You know, I feel like 1 in 20 buses coming more than 3 minutes late is probably pretty acceptable, but 1 in 20 buses not showing up at all is something quite different. I was just wondering if there was a specific reason. I couldn't recall that we have those targets at the same level.
Yeah, Anita.
Oh, I can find
Only
it
that
better.
they've been set by council, so we have adjusted them for next year down slightly. But I'd need to talk to the team specifically about why we've got those numbers.
That's a work in progress, I think, in terms of our performance measurements. So yes, it's been a coverall target.
So Ellie, just so I'm clear, because we obviously we pick this up every year through annual plan, and certainly long-term plans a good opportunity, but what you're saying effectively is that you would see the timeliness being, but reliability you would expect to see.
Yeah, exactly.
Yeah, as being a critical one to be close to 100%.
That might be something for us.
Yeah.
So,
Okay, just so we can keep that in mind.
Look, on the same thing, and it's just understanding where and how that's measured, and I'm sorry to go back to a point, and maybe it's next week's better place to have that discussion, but is this at the point of departure or as it goes through the trip?
So it's measured at every stop.
At every stop?
Yeah. So if you're off on one, potentially you're off on all of them.
Yes, very, very likely, but I hit at some stage we were measuring it at the start of I think at the very start of the trip, not necessarily at the hub. I'm just wondering how that'll work, but I'll do that for next week.
Yeah, I'll get the team briefed to talk through these things.
I think we give you focus.
Look, I think it's worth just making this clearer. The average punctuality for Dunedin buses is 85.7%. And the average punctuality for Queenstown is 90%. So those are the figures there in the public arena. Very good. Gretchen.
Mine's not a question, so when we move, I'll just make some comments. Yeah.
Okay. Yeah. Anything further? Okay, I think we're finished with this one. So we do have a recommendation to note this report and the activity performance report for the period 1st of July through to the 30th of June. And we also note that full audit performance results are included in the statement of service performance section of the report, which will be presented to the Audit and Risk Subcommittee in Council in September this year. So are you happy to move that, Gretchen? Thank you. And seconder.
Sure.
Alexa, thank you. And so up to you, Gretchen.
So just wanted to comment on this one and probably the previous one as well. A big thanks. It's been a big year for staff and actually a really good result, I'd have to say. As well in here, we've taken a conservative approach, as has been noted. So there is red, and I'd rather see that and flagging what are those items, and then we can really shine the spotlight on that. And generally, there's really good reasons as to why we haven't quite met those targets, but they stand out transparently, and I think that's really helpful for us. Thank you to the chairs of this committee as well, who've been guiding us through and making sure that we've got all the right measures in place. and also reporting as clearly and transparently as we can. I just wanted to note that it's quite clear that we've got a bit of a holding pattern happening on planning, and we know the reasons why that's happening, and it's coming through as well in the financial reporting too. So there's some savings there. We've discussed this as well, but there needs to be some discussion around where those savings potentially go to, or how we do our business going forward. We're doing a lot of work in the non-regulatory space, as well as our ongoing regulatory consenting compliance work as well, and that's coming through there. We're doing it well. So yeah, holding pattern happening, or not by our own doing, but is the reality. And then also, I guess there's a lot of measures there that I've already mentioned that are conservative. So the response to Official Information Act is an example of that, where we were so close to meeting that target. We've had a whole heap of them over the year. So some of them are very complex. So actually we've done really well. That's just one example. There's others as well, like public transport satisfaction, which so nearly met that target, but because it's a 3-year rolling average, makes it a challenge. We did meet it this year. We've done really fantastic work in that public transport space. Biosecurity is one that is coming through, as hasn't been met on the targets. So we as well got that pest plan review underway and thinking about that. And I think that comes back to what are our targets as well. We need to meet those targets that are in the pest plan. Again, through here, are some of those targets the right ones? And we always ask ourselves that as well. And there's some of that coming through, I think, too, in the non-achieved. So we can always probably get better on what are the targets that are going to be most meaningful for our communities when they're judging our performance, as they should. We talked about some in public transport just before. And yeah, we're always interested in as governance and need to be. And hopefully the new council will have a really good think about that as they develop the LTP as well. But I think there's a really good result here. I just want to say that. We've had to pivot and we've had to change our work programs. We've attracted additional funds than what we expected as well, through a lot of hard work of staff in a number of key areas in our council, probably all of them, I think. So just a really big thanks to our team as we navigate a changing space and do that really successfully, I think. So thank you.
Okay. Thank you, Gretchen. Anyone else? Andrew.
I just want to hone in on punctuality with regards to passenger transport services, and I think it's important to remember that target is a very high bar. Generally, customers or passengers probably have a varied tolerance when it comes to punctuality for all sorts of reasons. I think also it's worth remembering that congestion plays a part in punctuality. Roadworks plays a part in punctuality. And that thing's completely out of our control. And I suppose you could also say weather conditions as well. So yeah, I think looking at the big picture, that's still a pretty solid result. But I look forward to reviewing some of these targets so they're a wee bit more realistic.
Yeah. Thank you, Andrew. Okay, we have a motion. We'll put it. All those in favour, please say aye.
Aye.
Against? It's carried. Thank you very much. Okay, we have following up a financial overview. Back to you, Good.
Okay, so this paper is, it's just a noting paper to summarise the various Whareroonaka transactions. It came up in the last Finance Committee meeting. I was trying to remember whether it's Finance Committee or the LTP deliberations, but it was Finance Committee. And I actually think it was Michael Laws who was asking questions and trying to understand some of the variances. Particularly around in CapEx, where in the year that we've just had, you would have seen in the CapEx report, it shows that we're over budget. But of course, that's because we only had half of the CapEx budget in last year. The other half was actually in the year before. So what this paper is trying to do is just outline what the various transactions were and the cash flows so that you can see where they've been in the various LTPs and annual plans, because we started off back in the LTP 21-31 with numbers. That was before everything was priced up, and at that point we had assumptions around rent and capital contribution. Those were then subsequently amended in the 23-24 annual plan, but of course the annual plan is only 1 year, so you only see what we put in for that year. But that was following the decision by council in 2023 to for when we finalised the costings, and that's where the $2.6 million rent and the 11.2 million capital contribution was set. So those numbers were then reflected in that annual plan, and of course they bridged multiple years where we put half of the 11.2 million capital contribution into that year 3 annual plan and half into year 1 of this LTP. And then the LTP then had the ongoing rent from year 2 of the LTP at 2.6 million. That was subsequently amended for the annual plan that we're now in year 2, where we're only reflecting half of that annual rent on the assumption that we move in halfway through the year. And then a table right at the end, I've also outlined, and it's noted in there, the actual transactions that we've had to date. And all that we've had actually to date was in the last financial year, we paid an initial payment, the first payment of the 11.2. So that was 6.9 million. And that's why we were seeing an over budget amount in last year's CapEx, because effectively we'd had 5.6 million under the year before, because that's where we had the first 5.6 budgeted. And of course, also last financial year, we completed the sale of Birch Kitchener back to the port. So they're the only actual transactions we've had, and now we'll have the rest of the capital contribution go out this year, and then expecting the rent to commence from halfway through the year. So really, it was just an overview to hopefully outline it. I also pointed out in there, we'd always factored into, it was back in the previous LTP, not in this one, but the intention was always, once the payments have gone out for the capital contribution, the building reserve would have a residual in it. The plan was always that and the gains on any gains on the sale of the excess property would go into the general reserve. Once we've washed all of that up, there was a view that we would increase, the amount that we've got in the managed fund to generate additional investment income, which in turn would offset, our general rates and help offset the cost of the rent. So really, none of that from a strategic point of view, and the financial strategy has changed. Just that from the initial LTP where we put it in 21-31 to the current LTP and our annual plans now, the quantum changed when we brought that paper to council in early 2023 to get approval and when the numbers were finalised.
Mm-hmm. Yeah. So if we were to summarise that, then the ORC's contribution of 11.2 million is basically a rearrangement of the balance sheet assets. Is that correct?
Rearrangement of
We've sold property, we're planning to sell the ORC building in Stafford Street. It'll all contribute to a shift in the balance sheet from those assets into the Whare Rūranga.
Yeah, you could look at it that way. Yeah, we've got, with the value of, we've had two properties, and effectively those properties come off our books. They were being held at historic cost, and then we have assets go on the book being our leasehold improvements.
Yeah. So the ongoing cost to ratepayers for the new building will be operating expenditure only, which will be rental.
Yes.
Okay, and that rental will be paid to the Port Otago, and in some way comes back as dividends. Okay, thank you. Any other questions? Yeah.
Just in reference to Stafford Street, I assume that it'll pop up in the 25-26 financial statements that it's property for sale, property to be disposed of, or whatever. Because at the moment, in the current year has just finished, 24-25, it sits in, obviously in the property part, but it will move to the sale. And I suppose my question is really, we've got probably 6 months before we're completely settled in the new building. Is it our intention to get it ready for sale as soon as practicable after we've moved in to the new building, or is there anything else that government should know at this point?
We haven't had those discussions internally, but we'd factored in, ideally the sale would happen in this financial year that we move in, but there's a whole lot of work to happen, and it depends on where the market's at, whether there's a buyer for it. So you're right that once we've moved out of it, so for the financial statements for 25-26 by the end of the year, if we're still holding it and it hadn't sold, then yeah, it'll just be on our books as property held for sale, and we'll just deal with it in due course. Yeah.
Okay. Any further questions? All right, so the recommendations that we note this report, we have a mover of that, please. Gretchen, thank you.
Sorry, Tim.
Yes, come on. Yeah, your turn, Gary.
Yeah, sorry, I was just taking a wee while to get the buttons pushed. You just made a comment there about the lease cost and how it returns to us in some way with dividend. But that isn't, so we don't currently have dividend factored for over and above on lease cost at the moment, do we? Because dividend at the moment is calculated or has risen to a point of 20 million, and that will remain the same. And so the lease cost when we move in will be the new added lease cost. Like at the moment, we pay for 2 floors in Philip Lang House. So we will have a new lease cost, and that's been factored in our long-term plan. So I just wanted to just correct that point, that there is nothing factored now that dividend will increase to match the lease cost.
That's right, Gary. So there's no, the 20 million is what we've indicated the report will be the ongoing dividend in the most recent statement of expectations. So, and then the rental costs and our outgoings and our OPEX are increasing when we move into the new building.
Yes.
And sign this agreement. So I think the comment, and I don't want to speak for Tim, was probably more of a general one in terms of the increase in dividends over the last few years, but you are correct. There's no further increase in those dividends forecast, but there is a increase in lease costs forecast in the long-term plan.
Yes, correct, which is being borne by the ratepayers. Okay, no, thank you.
And just to add to that, the revaluation report of the target has made a big contribution to the ORC this year. and it was because of their land holdings and properties and assets at the port, which contributes to the ORC. Okay, we've got a recommendation to note. And we had Gretchen and Elliot, I think, or Alexa, seconding that. So we just put that motion. All those in favour?
Aye.
Against? Okay, that's carried. And that wraps up the meeting. So thank you very much. We'll have a break until the next one. It's at 11:30, I think, isn't it?
So just a note, while we finish this meeting, Karen and